Hi everyone, welcome back to Real Estate Market Minute with Macross Group. I'm here every week to break down what's happening in Southern California and national real estate in plain language. Here's what we're covering today. A fast rising wave of home insurance non-renewals, the national debt crossing $40 trillion, cooling home equity gains, a pullback in new construction, and this week's national market snapshot. Our first story is a big one. A new National Association of Insurance Commissioners report found that insurer-initiated non-renewal rates jumped between 96 and 216%, depending on the region, from 2018 to 2024. In 2024 alone, insurers initiated more than 2 million non-renewals nationwide. Breaking it down by region, the Southeast saw a 216% jump, and the Northeast was up 147%. Out west, non-renewals more than tripled in just 2 years, climbing from 8 to 25.1 per 1,000 policies. Premiums also rose, but non-renewals rose much faster. So why is this happening? Insurers took on about $98.2 billion in homeowners insurance losses in 2024, with the average claim costing around $13,349. Still, 715 companies were writing homeowners coverage that year. They're just getting much more selective. If you're buying in an area where insurers have pulled back, get a quote early in the process. And if your own policy isn't renewed, don't wait. Contact your insurer, then start shopping. Since one company saying no doesn't mean they all will. Roof age is one of the first things underwriters check, and documenting upgrades with permits and receipts can help your case. Next, a milestone that made headlines: the U.S. national debt topped $40 trillion last week. More telling than the raw number is the debt-to-GDP ratio, which is approaching World War II levels near 100% today and is projected to reach 120% in 10 years and 175% in 30, up from just 31.5% back in 2001. Why does this matter for real estate? As the government issues more Treasury securities, investors often demand higher yields, and rising deficit concerns can push up what's called the term premium. Both of those are tied to long-term interest rates, which influence mortgage rates. This is a macro trend worth watching, not a signal to time any decision. Topic 3. Home equity gains are cooling off. Nationally, 41.1% of mortgaged homes were equity-rich in the second quarter of 2026, meaning owners hold at least 50% equity. That's down from 43.3% in the first quarter and 47.4% a year earlier, the fourth straight quarterly decline. California is still ahead of the national average at 45.6% equity rich, but it saw one of the steepest year-over-year drops in the country, falling from 56.9% just 1 year ago. The silver lining, equity levels remain much healthier than they were before 2020, so most homeowners still have a real cushion. Now let's talk construction. U.S. housing starts fell 12.4% in July to an annual rate of 1.24 million. Single-family starts dropped 9.9% to their lowest level since November 2022, and multifamily starts fell 16.8% after a surge in prior months. Year over year, single-family starts were down 15.7% and multifamily down 8.9%, with the West region hit hardest at minus 20.7%. But there is a hopeful sign. Total permits issued rose 3.1% year over year, and single-family permits were up 1.1%. Single builders remain cautiously optimistic. Finally, this week's national snapshot from Altos Research. The median list price sits at $442,500, down $2,500 for the week. Active single-family inventory was up 1.57% year over year. A few more signals worth noting: the median price of new listings fell to $405,000. The share of listings with price cuts rose to almost 42%. Median days on market held at 63, and the national price per square foot sits at $214. Put together, this tells us the market is cooling, more homes are sitting, more sellers are cutting prices, and rates are still high enough to keep demand from surging back. For sellers, that means presentation and pricing discipline matter more than ever, and buyers may find a bit more room to negotiate. That's this week's Market Minute. To recap, insurance non-renewals are accelerating. The national debt milestone could influence long-term rates. Home equity growth is cooling both nationally and in California. Construction pulled back even as permits offer some hope, and the overall market continues to cool with rising inventory. For more on any of these topics or to talk through what's happening in your neighborhood, reach out to Macross Group or find us on Facebook, Instagram, YouTube, X, and LinkedIn. Drop your questions in the comments. I'd love to hear from you. And as always, this content is for general informational purposes only and isn't legal, financial, or professional advice. See you next week.